Well, hello there. Welcome to another episode live of Be the Boss of Your Money with Mitch Goldberg. If we haven't met yet, my name is Mitch. I am a financial advisor with the wealth management firm Client First Strategy. We have a few things to talk about, but the most important thing that you are going to hear, it's something you should be very familiar with, but just in case you aren't, I would like to bring you up to speed. There's an old expression that goes, don't fight the Fed. And is it still true, or is it just one of those expressions like sell in May and go away, or this time it's different, or one of those back of the envelope phrases that makes sense just enough times to suck people in, and then it won't work? Let's get into that. We'll do a quick market update. We're going to roll the intro, and then we're going to just get through this. I'm going to teach you something very, very important that'll help you become better with your money, better with investing. Here goes. Welcome back. I'm Mitch Goldberg. You're watching a new episode of Be the Boss of Your Money. I call it Be the Boss of Your Money because I want you to be the boss of your money, not your money to be the boss of you. It's very easy for that to happen, by the way. People lose control of their expenses. They don't know where all their money's going. They don't understand their taxes. They don't understand what their investments are. And before you know it, you're just further and further behind your money. And it's just, you get into problems when that happens. And I want to help you avoid that. If you're already in that, I want to help you climb out of it and just make you the best possible version of your financial self that you could be. Now, anyone who follows me knows that I always start with a quick update. So let's just take a quick screen share and get through this. Today was a pretty good day in the markets, and we should know why. Listen, I don't want to focus on short-termism, but it's always important to know what happens in the market because there is something, it's always important to focus on what happens in the market every day because there's always something new. There's always something to learn. Sometimes there are lessons that are continuously reinforced and you start to pick up certain patterns and lessons and you start to figure out the way of the market, how it really works. And when you start to figure that out, you do become a better investor. Every investor is different. Everyone has a different risk tolerance, time horizon, financial goals. So it's important to really know yourself and use that, combine that with what you've learned about investing in your personal finance. And that really is what can help you create value so it can help you create a future that you desire. I like to say, if you can dream it, you can plan it. Let's take a look. So the Dow is up a whopping 526 points. S&P was up 58 points, so just about 2%. NASDAQ was up about 1.75%, exactly 1.75%. And the Russell 2000 was up a little bit over 2%. So today it kind of moves us back to a V-shaped day, because you had that swoosh down in the stock market, that swoosh down in the economy. And it looks like today we're swooshing up. We're going right up. So you have the V, the downside, the upside. Okay, well, you know what a V looks like. There are a couple of reasons that the market went up today. The reasons that the market went up today are to me is not really actually what I want to talk about. You see at the bottom of the screen, it says, should investors keep fighting the Fed? We need to talk about that, but let's take a look. So today the Dow is up. Why was it up? It was up from the very beginning. At one point, the Dow was up about 800 points or so, and futures were up over 1,000 points this morning on the Dow. Believe it or not, folks, I don't actually look at the Dow, the market all day long. I do have work to do, and I actually find it counterproductive to just become a screen face and just stare at the computer. Go stare at the computer all day, because then you become batty. Your eyes you start to become blurry. Your vision is blurry. it doesn't help. I don't follow the stock market minute to minute. I always know what's going on. I always have my I always have my fingers on the pulse of the market, right? But the point is, you don't have to look at the market every second of the day. It's important to learn, to understand, to put things in context, and to become a better investor overall. What the stock market does tick by tick all day long actually has very little to do uh, with you building your net worth and preparing for big goals like retirement, or staying successfully in retirement, or saving for your kids' college education, things like that. I know there are a few people out there. I greatly appreciate it. I'm going to get to you. So today, the big thing was this. This morning, Bloomberg reported that that Trump would propose $1 trillion infrastructure bill, which everybody, I think, would agree on that. That would be a great thing. So that sent the market going up. And then news about a drug that helps fend off or helps people fight COVID-19. That is dexamethasone. It's similar to prednisone, except the dex is a lot longer lasting. It's more potent. And basically it's a steroid. It's a very strong anti-inflammatory, reduces inflammation in the lungs. And that has been shown in studies in England, who we trust, that is a really good, useful drug in fighting the COVID-19 infection and helping people get well and get out of the hospital. It's important to have that because one of the things that's been dragging the market down, that dragged the market down last week, was a big rise in hospitalizations, COVID infections, and hospitalizations. So people started to get worried. Is that going to be the end of this recovery? Because we were thinking that the states were reopening. It was going pretty well, a little quicker than people expected. Economic stats such as employment, which are still horrendous, but came in way better than expected. And a few other numbers like housing have been coming in better, and consumer confidence has been coming in better. But then when you get the COVID-19 hospitalization reports, you could think that maybe consumers will slam the brakes, are going to stop going out, and we're going to go right back into what we were during March and April. All right. So that was the worry. But then you have a drug like this come out, and you had a few big things, some news out. So let's just go on. Let's take a quick look. Today also, retail sales jumped. Biggest jump in actually the biggest jump ever for retail sales. Let's get rid of that. Infrastructure stocks that are on the move and stand to benefit. This is just to highlight the infrastructure potential. I don't want to show you all the stocks now. I've got other things to show you. Okay, we already went over this, how the market did. So let's go on. Infrastructure spending, retail sales. Retail sales were up a whopping 17%, which is just a tremendous number, but they were down about 15% or so the month before. So it kind of reinforces the V-shaped recovery that some economists have been talking about, certainly that I've been talking about a lot over here at Be the Boss of Your Money. Stocks continue to trade above their 200 moving day average. That means that money managers feel and traders feel that it is, clear for takeoff for buying stocks. And a lot of money managers are behind their benchmarks. If you're a fund manager, hedge fund manager, mutual fund manager, if you are behind the benchmarks by a lot and the stock market's taken off, but you went all into cash or just all into, coronavirus stocks, like just consumer staples, and you saw this market go up, and now maybe let's say the market is off a little bit and you're down like 20 or 30%, you've got a problem. So you've got to chase stocks. You've got to start putting that cash away and buying like crazy. Institutional cash went down by quite a bit last month. So a lot of money has been plowed into the market. I don't think we're at the end. I've been saying repeatedly, I don't think we test the March 23rd low. March 24th, I actually said that March 23rd is the low. And you never know, but I don't think we go back. I just think we're just going to have a up and down pattern and in a generally uptrend. All right, so last thing, let's just take a look at some of the industrials. United Rentals, Caterpillar, and Boeing in particular. You see these stocks had nice days. These are the exact kind of stocks that would be helped from an infrastructure spend. And then lastly, we'll take a look at the sector ETFs. If you want to know what I follow every day, I follow the sector ETFs that represent the 11 major sectors of the economy. The leaders today were energy, which you'd expect from a potential infrastructure bill. Healthcare, not really, but it's up today. Technology had a strong day. Discretion, building materials, and industrials. This is something that I if I have to be a little negative today, if I have to find something to harp on because I can't leave well enough alone, I would have liked to have seen industrials and financials all the way up here, at the top of the leaderboard. To me, that would have been a much better indication that this is a really healthy bounce. We still haven't recovered quite half of the losses from last week, but we're working on it. But I'd like to see financials and industrials lead the way. I'm happy, energy. Look, I'm happy for an up day, but I've also said I don't want I don't like these up 500, 600 point days and down 500 or 600 point days. I'd like just a little bit of a boring market for a little while. But if you blink, you miss it, right? So that's really what's going on with the market. That's enough for the update. So let's get into the Fed. Don't fight the Fed. I'm going to teach you something in a couple of minutes. It's really important. It used to be, I feel so old when I say that. It used to be, sound like my dad. You know what's weird? I was listening to had the radio on the other day in the car, and U2 song comes on, With or Without You, from the Joshua Tree by my favorite band, U2. And I'm, getting into it, With or Without You, and I'm, singing. I'm a really bad singer, so I'll spare you any more singing. And then at the end of the song, it said, "You're listening to the Golden Oldies." That song came out in 1987. And I'm like, are you freaking kidding me? You're calling my music the Golden Oldies? And I'm thinking, I remember when my father used to listen to the radio in the car, and then the DJ would say, the Golden Oldies. I'm like, oh my, that is just like, it's a weird feeling, to hear that your music that you grew up on is Golden Oldies. Okay, so don't fight the Fed. It's an old expression, and back in the day, the Fed, I got into the business in 1990. It wasn't such a common thing for the Federal Reserve to make big announcements. Generally speaking, when the Fed spoke, the chairman of the Federal Reserve, the chairman of the Fed, would, at the time when I got into the business, was Alan Greenspan. It was a rarity that Greenspan would speak and make an announcement, and the Fed would do something dramatic like cut rates or lower rates. And the Fed tried very hard to throw investors off, to throw the scent off. Okay. So that it was very unusual for the Fed to make a big announcement. And then you had Bernanke and Yellen, and now we've got Jerome Powell as chairman of the Federal Reserve. So it's hot, little iced coffee. But now, the Fed makes announcements, all the time. And it happened since the Great Recession about 10, 11 years ago, where the Federal Reserve took a much more active and public role in the economy. A lot of people think it's really bad. A lot of people think it's really good. I'm definitely in the middle, but if I had to pick a side, if I couldn't just straddle the fence, I'm going it's a little bit more bad than good. Because what the Fed is trying to do is they're trying to make every recession as painless as possible. And sometimes you need a recession. I mean, look at me. People say, well, you're obviously doing well, so it's easy for you to say. Listen, I've been doing this for 30 years. It hasn't always. I've had plenty of ups and downs in my career. Look, I'm 53, so I started in the business when I was 22. So I've had plenty of ups and downs like everybody else in my adult life. Okay, but the Fed is trying to make everything as painless as could be, but in the process, the tools that they use to fight the recession are often the tools that the Fed is using to maintain low inflation and full employment, which the way it works, it just creates um, a bigger market. It creates a bigger market, a bigger stock market, a bigger money supply, more leverage, and it just, it keeps going on. And the problem is when you have more leverage and you get less business out of taking on new debt, both for the country and for corporations, that's when debt becomes unsustainable. Okay, when you start getting less and less out of debt, I'm not saying get out of debt. I'm saying when you start getting less and less bang for your leveraged dollar, that's when debt starts to become unsustainable. And I do believe we're there as an economy and as a society. What's the solution? It's tough to say, because if you don't do what we do, we will have a very painful recession. Nobody wants the pain. Greenspan, when he was Fed chairman, I think he was a lot more willing to accept pain. The chairman of the Federal Reserve before him was Paul Volcker, who jacked up interest rates to fight off inflation in the early 80s. Back then, money market was like 12 or 13% interest. He jacked up rates and threw the economy into recession. He was willing to deal out the pain to tame inflation. We don't have policymakers who are willing to do that. So you have to just keep blowing the bubble, so to speak, bigger and bigger and bigger. So yesterday, the Dow was off about, it was off like 800, 1,000 points. It was going to be a really bad day yesterday. And the Fed comes in and says, hey, you know what? We're going to buy individual corporate bonds. And the market recovered and shot up into a positive day. Not an overwhelmingly huge day, but still, from being down so much to being a decent up day, you could tell how the Fed's impact hit the market. How it helped the market, because as soon as the Fed made the announcement, stocks turned on a dime. So yes, the Fed obviously has an impact in the market. I don't want to come out and say, well, it's all because of the Fed. It's all because of interest rates. There are other things that affect stocks and bonds, financial assets and hard assets in terms of price performance. It's not just the Fed policy, but right now it's mostly Fed policy. So do we worry about the economy? And that's been the big thing. Why are stocks doing so well when the economy is in such tatters? And now we've gotten some decent economic news with retail sales, with employment, with home construction, consumer confidence. We're getting some better news, or I should say, at least the news is less bad. Is not as bad as expected, but it's still on the upswing. Okay, but the Fed comes out yesterday and says, we'll put $750 billion into corporate bonds. And then they had something else. I'm going to share my screen to show you this, because we're going to come to a conclusion, okay? We're coming to a conclusion of whether or not you should fight the Fed. And then the Fed, yesterday, this is the news from yesterday, the Fed is finally starting its lending program. There's not news from this. This is news from this is a continuation of news. So I told you that the Fed's buying individual bonds. Okay, but now the Fed is starting its lending program for small and medium-sized businesses. That is pretty significant. So it doesn't mean that the Fed is actually going to lend money directly to businesses, but what they're going to say, kind of like the PPP loan, I don't know if you're familiar with that, they'll say to banks, make loans to businesses with these set of standards. Just get the money out as much as you can go, and we'll take on 95% of the risk. That's the number, 95% of the risk that you lend. Okay. So now smaller businesses, typically what happens in a recession, smaller businesses don't have such great access to capital, whereas large businesses have great access to capital. Even Macy's floated a multi-billion-dollar bond. Even Hertz is going to sell or will sell or did sell $500 million worth of stock, in spite of the fact that they basically said you'll probably get zero. It'll be zero after you buy it. So it's easier for larger companies to have access to capital. So the Fed is now becoming like the bank to banks. It is the central bank, but in terms of lending to small and medium-sized businesses, and the Fed's not buying corporate bonds, and it put interest rates at zero. So my thing is this: the stock market is in recovery mode. It's not going to be easy, but should you keep fighting the Fed as an investor? And the answer is clearly no. We've always said that throughout my entire career: don't fight the Fed. And the worry over the last few years is the Fed could run out of bullets, run out of ammo, whatever you want to say, however you want to put that. But apparently it is limitless what the Fed can do. And the Fed could initiate $500 billion to $1 trillion spending program on literally anything it wants at any time. And no one's going to stop it. No one. I mean, I was listening to Fed Chair Powell's testimony before Congress today. I had to drive out to see some clients today, which is wonderful, and it's good to see them because they're also good friends, and it's just great to finally get out and see people face to face, especially these people because they're just lovely, and it was just a great day. But it was about a 45-minute drive each way. So this morning I was listening to the Fed, and you could tell by what the politicians are asking. No one said stop it or don't do it or anything like that, because nobody is willing to go through the pain of a nasty recession on their watch. Plus, there's nothing like a president who wants to get reelected, who will basically put out any stimulus or policy or plan to help the economy, especially when President Trump runs, on the economy. So this is not such a bad time for investors. I hate to say that way because of what's happening in the real economy, but for investors, this is we have a Fed that is so unbelievably accommodative that they come out and say we'll spend $750 billion on individual bonds. They're not buying, like the Fed is already buying exchange traded funds and bond ETFs. I actually received a list of the ETFs that the Fed is buying. And they're buying bond ETFs, some from Vanguard, some from BlackRock, some from other shops. Now, corporate bonds, they're buying individual bonds, and thern're going to build this bond portfolio. And Bernanke Powell, Chairman Powell said, well, we're not going to be like an elephant, going through a crowd or something like that, to buy all bonds that we can. But when the market needs support, we'll buy it. When the market needs support, they're going to do whatever they need to do. So should you fight the Fed? I think the answer is no. All that I could have just said no in the first place. So let's just take a look to see who's out there. Hey, John Tutt is out there. Good to see you, buddy. Got a couple of comments. Let's see what's out there. If you can dream it, you can plan it. Mitch Goldberg. That's right, buddy. Thank you, buddy. Big day in your market. Thank you, James. James, how is it by you? James's market is the ASX 200 because he is in Melbourne, Australia. And who else do we have here? We have Keith, Superstar Mitch. Ooh, we're so good, man. By the way, when Ruff asks you if you're sponsored by Hawaiian Tropic because of your golden tan, I mean, I still laugh at that just thinking about it. But it's good to see you. By the way, folks, Keith Wilson also does live streams, so connect with him on LinkedIn and he'll tell you all about it. But he's bringing great information to investors, and he is definitely a resource, and he's been in this business for a long time, and he's a really good human being, which is the best part. All right, so that's about it. I want to thank everybody for watching, and I'll see you tomorrow. Thank you.